Is investment without peace really a gain? If your portfolio grows, but your anxiety grows with it. If your returns increase, but your sleep decreases. Is that truly profit? This question goes beyond finance. It enters psychology, behavioral economics, and well-being research. Let's examine it systematically. 1. Financial gain is not equal to psychological gain. Traditional finance defines gain as increase in monetary value. But human well-being research shows money and happiness are correlated, not identical. Economists Daniel Kahneman and Angus Deaton found that income improves emotional well-being up to a certain level, after which the effect flattens. Beyond basic security. Emotional stability matters more. Perceived control matters more. Stress levels matter more. If investing generates chronic stress, the psychological cost may offset financial benefit. 2. Volatility and the stress response. Market volatility activates the body's stress system. Elevated cortisol. Increased heart rate. Heightened threat perception. Research in neuroeconomics shows financial losses trigger brain regions associated with physical pain. If an investment strategy produces constant checking, sleep disruption, mood swings, irritability, then the return must be evaluated net of mental cost. Profit measured only in money ignores biological consequences. 3. The hidden cost of emotional bandwidth. Cognitive resources are limited. Obsessive monitoring of markets consumes attention, energy, focus, time. Psychologist Roy Baumeister has written extensively about decision fatigue and limited self-control resources. If investing drains emotional bandwidth, it may reduce work performance, relationship quality, long-term clarity. In that case, the financial gain may come at a broader life expense. 4. Loss aversion amplifies psychological cost. Research by Daniel Kahneman and Amos Tversky shows losses feel roughly twice as painful as equivalent gains feel pleasurable. This means a 20% gain may feel good. A 20% drop may feel devastating. If your strategy produces frequent emotional swings, your nervous system experiences more pain than pleasure, even if long-term returns are positive. Mathematically profitable. Emotionally exhausting. 5. The hedonic adaptation effect. Humans adapt quickly to higher wealth levels. What once felt exciting becomes normal. Psychological research on hedonic adaptation shows gains lose emotional intensity over time. Stress responses often persist longer. This means the pleasure of winning fades. The anxiety of losing remains vivid. Without peace, the emotional reward curve declines. 6. Identity-based investing increases emotional volatility. If portfolio performance affects your self-worth, gains validate you. Losses threaten you. Identity fusion increases emotional amplitude. When investing becomes personal, it becomes heavier. Peace requires psychological distance. 7. Long-term wealth requires emotional sustainability. Successful long-term investing depends less on intelligence and more on consistency. As argued by Burton Malkiel in A Random Walk Down Wall Street, markets contain substantial randomness in the short term. Sustainable investing therefore requires emotional resilience, volatility tolerance, patience. If your strategy destroys peace, it becomes harder to sustain long-term discipline. Unsustainable strategies often collapse during stress. 8. The real definition of net return. Consider redefining return as financial return minus emotional cost minus time cost minus stress cost. A strategy that yields 15% annually but produces constant anxiety may have lower life return than a calm 8% strategy. Wealth is not only capital accumulation. It is freedom, clarity, and stability. 9. Peace is a risk management tool. Peace is not passive. It signals appropriate risk level, alignment with time horizon, adequate diversification, realistic expectations. Chronic stress may signal overexposure, leverage misuse, short-term obsession, identity attachment. In this sense, peace is feedback. 10. When is it truly gain? Investment can be considered true gain when it provides financial growth, emotional stability, time freedom, predictable structure, psychological safety. If it only provides money but removes peace, the trade-off must be consciously chosen. Otherwise, you are exchanging calm years for volatile numbers. Conclusion. An investment that does not bring peace may still increase wealth, but it may decrease well-being. And wealth without well-being is incomplete profit. The strongest strategies are not only mathematically sound, they are psychologically sustainable. Because in the long run, a strategy you cannot emotionally survive is not truly profitable.